So imagine walking into a boardroom and telling your investors that you are taking a centuries-old, completely weather-dependent farming business.
Right.
And you're just piling on $1.5 billion in debt to buy a massive industrial chemical plant.
Which is a bold move.
I mean, it's wild, right?
Yeah.
In almost any other scenario, you would be laughed right out of the room. Wall Street typically, they absolutely hate style drift.
Oh, absolutely.
They hate when a company completely rewires its corporate DNA because it introduces these entirely new categories of risk. But today, you and I are looking at a company that did exactly that, and the market isn't laughing at all.
No, they're really not.
In fact, Wall Street is giving them a standing ovation. Welcome to Talk Tickers. Today, we're doing a deep dive into Adecoagro, ticker symbol AGRO, and we're unpacking their Q4 and full year 2025 results.
Yeah, and it's a fascinating setup.
Right out of the gate, after this print, the stock just surged like over 14%. We are talking about massive sustained trading volume here, hundreds of percent over their average daily volume.
What's fascinating here is really the sheer dichotomy of the financial reality we're looking at. We're essentially analyzing a tale of two entirely different timelines.
Okay, break that down for me.
Well, if you're, say, a purely algorithmic investor, or if you only look at the trailing numbers, the historical performance on paper, it paints a picture of a company under severe, almost existential pressure.
Yeah.
The trailing metrics are, quite frankly, they're awful. But the market isn't looking backwards. Institutional capital is entirely focused on the pro forma future, a timeline that essentially begins right this very second.
I want to spend some time on that dichotomy because if you just read the headline print without the context of this massive transformation, you would think the company was in a death spiral.
Oh, 100%.
Let's look at the anatomy of this headline miss just to set the stage for how wild this 14% market rally actually is for you listening at home. So Q4 adjusted earnings per share was a 7-cent miss. They came in at a 16-cent loss versus a 9-cent loss consensus. For the full year 2025, they posted a net loss of $6.8 million.
Yeah, pretty.
And the metric that usually sends institutional investors running for the exits, right? Adjusted EBITDA, that plummeted nearly 38% year over year, dropping down to $276.7 million.
It's a steep drop.
It is. Now, looking at these trailing numbers is it's kind of like staring at a caterpillar's ugly cocoon phase, but the market is bidding up the stock because they already see the butterfly.
That is exactly the right mechanical framework. The headline numbers are the cocoon.
Yeah.
And they completely ignore the massive transformative acquisition that closed in mid-December.
Right.
So that 14% market rally, that's the market pricing in the butterfly. To understand the current valuation of why the street is aggressively bidding this up, you have to just, throw out the trailing gap number.
Just ignore them completely.
Yeah, exactly. You look exclusively at the pro forma reality. Pro forma meaning what does the math look like if we assume a full, uninterrupted 12-month run rate of their newly acquired asset.
Okay, and when you do that?
When you run those pro forma numbers, the top line doesn't look sluggish at all. Revenue actually sits at over $1.4 billion.
Wow.
Yeah, and management is pointing to a very clear, highly credible line of sight to cross the $2.0 billion threshold in the near term. Furthermore, pro forma adjusted EBITDA wouldn't be that depressed, $276 million.
What does it jump to?
It immediately jumps up to $467.2 million.
Which is a staggering delta. I mean, we are talking about nearly a $200 million swing in operational cash flow capability just by changing the lens through which we view the business.
Exactly.
And that brings us to the massive elephant that just walked into the room, right? The literal new engine for this company, Profertil.
Yes, the Profertil deal.
Adecoagro just acquired a 90% stake in Profertil for $1.1 billion. Let's really examine the mechanics of this transaction because the way they structured the financing for this $1.1 billion price tag, it tells a profound story about their risk tolerance, right?
It really does.
So they financed it with 3 tranches. First, $400 million in cash straight from the balance sheet.
Yep.
Second, they took on $400 million in new long-term debt. But this isn't just standard paper, right? It is 7-year debt with a highly strategic 2-year grace period on the principal.
Which gives them massive breathing room.
Exactly. And then third, they raised $300 million in new equity.
We really need to pause and analyze that equity raise, actually, because it is the most telling signal for you as an investor navigating this space.
How so?
Well, the $300 million new equity wasn't just floated out into the open market via some standard secondary offering, hoping that retail or passive funds would just absorb it.
Right.
It was anchored by Tether, who happened to be their controlling shareholder.
The crypto guys.
Yeah, exactly. When a controlling shareholder, especially an entity with the massive, almost unparalleled capital flexibility of Tether, steps in to anchor an equity raise of this magnitude to fund a specific acquisition, it signals incredibly deep insider conviction.
I mean, they're putting their money where their mouth is.
Exactly. They aren't just passively supporting the legacy business, they are actively, aggressively financing its industrial transformation. From a capital markets perspective, this is a watershed moment.
Yeah, because this marked Agier's return to the public equity markets for the very first time since their IPO, all the way back in, 2011?
Right, exactly.
But wait, I want to challenge this narrative just a bit here.
Go for it.
Because on the surface, yes, Tether anchoring the deal looks like a massive vote of confidence. But we are talking about a crypto-adjacent entity playing in the physical, hard asset world of South American agriculture and chemicals.
True.
Are we entirely sure this is purely an operational conviction play? Or is there an element of capital parking happening here? I mean, they need places to put those dollars.
It's a vital distinction to make, honestly. But if you look at the structure of the asset they just bought, it aligns perfectly with a hard asset cash flow generative thesis.
Okay.
Tether isn't managing the day-to-day crop rotations, right? They are deploying capital into highly defensive monopolistic infrastructure, which brings us to what they actually bought for that $1.1 billion.
Let's get into it.
They purchased the sole major urea production asset in Argentina. This isn't some speculative venture. It is an entrenched, highly optimized facility boasting 1.3 million tons of installed capacity.
Wow.
Yeah, it is literally the largest fertilizer production facility in all of South America.
But this is exactly where the execution risk thesis comes into play for me. I mean, for 2 decades, Adecoagro was fundamentally a farming and sugar company.
Right.
They managed soil, they managed cane, they managed biological assets subject to the weather. Now, suddenly, they are running a massive, highly complex industrial chemical plant.
It's a big pivot.
A huge pivot. The engineering required to operate a high-pressure, high-temperature urea synthesis facility is light years away from the logistics of moving sugarcane from a field to a mill. So isn't this a massive distraction?
I see where you're coming from.
If you are an investor, shouldn't you be deeply worried about the execution risk of them spreading so far outside their historical circle of competence?
It is the single most important question regarding this pivot. And it was the exact bear case being actively modeled prior to the deal closing. But you have to look at the structural shift in their earnings volatility.
Okay, walk me through that.
Well, first off, you have to realize they aren't firing the chemical engineers who already run the plant. They're acquiring the operational talent alongside the physical steel.
Oh, that makes sense. Buying the expertise.
Exactly. But what this acquisition does is dramatically shift the company away from being hypersensitive to localized weather events. The notorious boom and bust cycles of soft commodities.
Right, the farming cycle.
Yeah. It transitions them into an industrial capability model. They've essentially reorganized the entire corporate structure into 3 balanced countercyclical earning streams.
What are those?
Division 1 is sugar, ethanol, and energy. Division 2 is the new fertilizer segment. And Division 3 is the legacy food and agriculture business.
Okay.
You are essentially trading unpredictable biological and weather risk for highly predictable industrial execution risk. And historically, capital markets assign a much higher multiple to industrial predictability.
I understand the theory of trading weather risk for industrial predictability, right? But let's test that predictability against the actual numbers. Because even if we look at the pro forma math for the fertilizer business, it wasn't exactly all sunshine and rainbows.
It wasn't.
The pro forma fertilizer EBITDA dropped 35% year over year, down to $196.5 million. So if this profitable asset is supposed to be the stable, cash-printing industrial cow that balances out the volatile farming business, how do we explain a 35% drop in earnings right out of the gate?
You explain it by looking at the operational calendar, which management accurately described as a perfect storm of downtime in late 2025.
What happened?
Well, Profertil suffered 90 days of lost operations.
Wait, 90 days, 3 months of zero production in a facility that is supposed to run 24/7.
Exactly. But we have to dissect the composition of those 90 days because it reveals why the market is entirely ignoring that specific earnings drop.
Okay, lay it out.
So 54 of those days were dedicated to a scheduled turnaround. Now, in the context of chemical manufacturing, a turnaround is not just flipping a switch off and sweeping the floors, right?
Right.
This was the largest planned maintenance, upgrade, and capital expenditure cycle in the plant's entire history. And crucially, it was executed right before the acquisition officially closed.
So they bought a freshly upgraded plant.
Basically, yeah. During a turnaround of this scale, they are replacing high-pressure reactor vessels, they're swapping out spent chemical catalysts that drive the ammonia synthesis, testing miles of thermal piping, and structurally reinforcing the core infrastructure.
That's massive. But what about the other 36 days? Or wait, 31 days?
Yeah, 31 days. So right on the heels of that massive 54-day project, they lost another 31 days because a third-party gas distributor's facility flooded.
You're kidding.
Nope. This was a freak natural disaster at a vendor site that completely interrupted the natural gas supply to the plant.
So to summarize the timeline here, a massive, highly complex, planned infrastructure upgrade, followed immediately by a literal flood at a supplier's facility that cuts off their critical feedstock.
Right. And understanding that exact sequence of events is the key to unlocking why the market rallied 14% on what looked like a bad quarter.
Because it's a fluke.
Yeah, exactly.
Yeah.
Institutional investors realize that these are one-off, completely non-recurring events. The asset is not fundamentally broken. In fact, it's the exact opposite.
Right, because of the upgrade.
Yes, because they just completed that grueling 54-day turnaround. The asset is now freshly upgraded, structurally sound, and physically capable of running at absolute full capacity throughout 2026 and beyond.
So the market is looking past the 90 days of offline friction.
Precisely. They are looking directly at a pristine, fully optimized asset that is ready to print cash.
This transitions us perfectly into the absolute core of the bull thesis. And here is where it gets really interesting. This is the mathematical architecture that I just find completely fascinating. The operating leverage.
Oh, it's incredible.
We need to detail the specific cost structure of producing urea at this plant, because this is the economic moat that protects that entire $1.5 billion debt load.
Absolutely.
To understand urea production, you have to understand the chemistry. You don't just mix dirt and water. You take natural gas, which is methane, and you reform it with steam to strip out the hydrogen.
Yeah.
Then you combine that hydrogen with nitrogen from the air to make ammonia, and then you react the ammonia with carbon dioxide to create urea. Because of this chemical reality, 60% of the cost to produce a ton of urea is the natural gas feedstock.
It's incredibly energy intensive.
Extremely. But Adecoagro didn't just buy the physical plant. They inherited the underlying supply contracts. They have legally locked in fixed-price natural gas contracts all the way through 2027.
Which, if you are operating an industrial chemical facility in a highly inflationary environment, is the absolute holy grail of risk management.
It is the ultimate shield. But, okay, let me stress test this. They are operating in Argentina. The gas comes from the Vaca Muerta shale, right?
Correct.
Argentina has a long documented history of tearing up contracts, altering regulatory frameworks overnight, and shifting domestic energy priorities when the sovereign debt gets too heavy.
Yeah, that's historically accurate.
So how secure is a quote-unquote fixed price contract in a country that operates with that level of sovereign volatility?
It is a deeply valid concern. And honestly, it is the primary reason the sovereign risk discount is always applied to Argentine assets. However, you have to look at the macro priority of the current administration. They are desperately trying to incentivize foreign direct investment. They want to signal to the global capital markets that the rule of law regarding commercial contracts is sacred.
So they don't want to spook investors.
Exactly. And beyond that, breaking a localized gas contract for the sole domestic provider of fertilizer, a product that directly fuels their agricultural exports, which are the main source of their U.S. dollar reserves, it would be economic suicide.
Because they need those farming dollars.
Yes. The state relies on the agricultural dollars that this fertilizer helps generate. The contracts are as secure as they can practically be because the state's interests are perfectly aligned with the plant running efficiently.
Okay, assuming the contract holds, the result is a rock-bottom cash cost of about $180 to $190 per ton to produce urea, excluding SG&A.
Right.
That means they know, essentially to the penny, what their core production liability is for the next 2 years, completely insulated from the volatility of the global energy markets.
And we have to contrast that perfectly fixed cost floor with the massive pricing tailwind they're currently riding on the revenue side.
Let's talk about the revenue.
Let's break down the global macroeconomic situation regarding fertilizer for a second, because it is the engine driving this multiple expansion. Urea prices have spiked 30 to 40% recently on the international spot markets
Why such a huge jump?
because of severe ongoing geopolitical conflicts in the Middle East. You have massive disruptions in major global supply routes, specifically the shipping lanes around the Strait of Hormuz and the Red Sea.
Right, the Houthis and the shipping attacks.
Exactly. Roughly 30% of the urea that physically lands in South America originates in the Middle East and must transit through those contested waters. When that supply chain gets choked, insurance premiums skyrocket, freight costs double, and global urea prices rocket upward.
And South America is already structurally starved for this specific nutrient, right? I mean, they don't have the domestic capacity to meet their own agricultural needs.
They are massively structurally short. The South American region, driven heavily by the massive agricultural engines of Brazil and Argentina, imports roughly 10 million tons of fertilizer every single year.
10 million tons.
Yes. But the continent only produces about 1.5 to 1.7 million tons domestically.
Wow. So demand just drastically outpaces local supply.
Exactly. Therefore, when Agro produces a ton of urea at the Profertil plant in Argentina, they do not sell it at some localized discounted rate. They sell their domestic product using what is known as import parity pricing.
Explain that for the listener.
This is a crucial concept. They price their domestically produced urea based on exactly what it would cost a local Argentine farmer to import a ton of urea from the Middle East.
Oh, I see.
That imported price includes the baseline commodity cost, plus the wildly inflated ocean freight, plus the war risk insurance, plus the port offloading fees, plus the local truck transport.
That's brilliant.
So Agro produces it locally for $180, but they charge the farmer the fully loaded global import price.
Wait, I really want to isolate this mechanism so you at home fully understand the leverage here. Their core production costs are aggressively locked at $180 to $190 a ton until 2027.
Yes.
But their selling price is completely floating. It's riding the wave of global geopolitical conflict, soaring insurance premiums, and international shipping bottlenecks.
Exactly.
They capture the entire freight and insurance differential as pure, unadulterated profit.
Exactly. It is a textbook asymmetrical margin setup. They are capturing the geographic arbitrage of simply existing in a structurally short market.
That is insane.
Out of the 1.3 million tons they have the capacity to produce annually, they have already forward sold about 200,000 tons in the early months of this year to secure baseline cash flow.
Okay, so they've got some guaranteed revenue.
Right. But that leaves a massive, unhedged 1.1 million tons of production fully exposed to these surging market prices.
1.1 million tons riding the global price wave.
Exactly. Because the natural gas cost is fixed, every single extra dollar that the global urea price goes up falls straight to their bottom line. There is no commensurate increase in their cost of goods sold.
Wow.
This exact mathematical leverage, the widening spread between a fixed $180 cost and a globally inflating import parity price, is exactly why management is publicly eyeing a mid-cycle EBITDA potential of $700 million for the consolidated business.
It is a beautiful setup. They essentially bought a massive, unexpiring call option on global urea prices and shipping container rates, but with a downside floor completely protected by fixed-cost domestic natural gas.
Precisely. And the sheer volume of cash flow generated by that fertilizer spread is what will fund the modernization and de-risking of the rest of the business.
Well, let's pivot and examine that rest of the business, right? The legacy operations that built the company. Let's look at the sugar, ethanol, and energy segment.
Yeah, let's look at Q4.
We talked about weather risk earlier, and Q4 gave us an absolute masterclass in how biological volatility impacts a balance sheet. The region saw incredibly heavy, persistent rains, which absolutely ruined the number of effective milling days.
It was a very wet quarter.
Yeah, and if you've never been on a commercial sugar plantation, you have to understand the physical reality. You just physically cannot get massive multi-ton harvesting equipment into muddy, saturated fields without destroying the root systems of the crop.
You just tear the fields to shreds.
Exactly. So sugarcane crushing volumes were drastically down for the quarter.
The immediate operational impact was severe, absolutely.
Right.
But again, you have to look past the immediate quarter and understand the agronomy.
You're right.
There was massive silver lining to those heavy rains. Yeah. That unharvested cane didn't just die or rot in the field. It essentially acted as a biological battery.
A biological battery, I like that.
Yeah. It stayed in the soil and soaked up all that excess water, storing it as future mass. What that created is a setup for phenomenal yields for Q1 of 2026.
Because they don't stop, right?
Exactly. Because AGR operates a continuous harvest model, meaning they don't completely shut down their operations and mothball their equipment in the traditional off-season, like many of their peers. They're already out there right now, taking advantage of the improved weather, harvesting that incredibly dense, water-rich cane.
I've always thought they operate this specific business segment like a giant industrial switchboard.
Oh, that's a good analogy.
If the sugar line goes dead or if global sugar prices soften, they just pull the plug on the sugar crystallizers and route all the sucrose directly into ethanol distillation. And we saw that exact operational flex in the quarter.
We really did.
Can you detail this mix for me? Because the speed at which they shifted their production profile is staggering.
The agility of their infrastructure is their primary advantage in Brazil. In Q4, they shifted their production away from sugar and routed a massive 72% of their total sucrose mix into ethanol production.
72%?
Yeah. That late-year pivot dragged their full-year mix up to 58% ethanol. To understand why they made such an aggressive pivot, you have to look at the highly localized macroeconomic and regulatory drivers operating within Brazil.
Okay, what's happening in Brazil?
First, you have very low ethanol inventories across the entire country. Reserves are down roughly 25% year over year. Second, you have rising domestic gasoline prices orchestrated by Petrobras.
Right, the state oil company.
Exactly. Because most cars in Brazil are flex fuel, meaning they can run on either gasoline or hydrous ethanol. The price of ethanol is intrinsically linked to the price of gasoline at the pump.
So when gas goes up?
When gasoline prices rise, it gives ethanol producers the headroom to significantly raise their own prices while still remaining the cheaper, more competitive option for drivers.
So they have tight supply and expanding price ceilings. But there's a regulatory kicker here too, right?
Yes. The third and perhaps most impactful driver is the new E30 mandate. The Brazilian government mandated a 30% anhydrous ethanol blend in all standard gasoline, and this became effective from day one of the year.
Which acts as a massive legally enforced demand floor. They literally legislated an increase in consumption. But explain the difference in the ethanol types here, because the E30 mandate requires anhydrous ethanol with the water entirely removed so it mixes with gasoline.
Right.
But you mentioned they are capitalizing on hydrous ethanol for the flex fuel cars. How does the margin profile differ?
It comes down to processing costs. Anhydrous ethanol requires an extra distillation step to remove the remaining 5% water, which costs energy and money.
Okay.
Hydrous ethanol, the stuff that goes straight into the dedicated ethanol pumps for flex fuel cars, skips that step. When you combine the low national supply, the higher competing gasoline prices, and the mandated blending demand sucking up all the anhydrous supply, it creates a vacuum that makes hydrous ethanol highly profitable.
How profitable are we talking?
Right now, it's netting them an equivalent of 16.5 cents per pound of sugar equivalent. When you compare that 16.5 cents to the current, somewhat depressed global sugar prices, ethanol is drastically beating sugar on a pure margin basis. That is why they threw the switchboard to 72%.
And what blows my mind is that despite the heavily reduced crushing volumes in Q4 caused by the rain, their cost discipline was staggering. Their cash costs held perfectly flat at 12.8 cents per pound.
It's really impressive.
Now, if you know anything about manufacturing or heavy industry, you know that usually when your production volume drops, your per unit fixed costs explode. You are forced to divide the exact same massive overhead, the leases, the salaried workers, the maintenance by fewer units produced. But they kept it entirely flat. How is that mechanically possible?
They achieved it by getting utterly ruthless with their operational efficiency. They didn't just absorb the downtime, they optimized it.
Give me some examples.
Well, they used a less heavy machinery, which drastically cut their diesel consumption. They utilized advanced AI-driven routing technology for their transport trucks, ensuring that every mile driven was fully loaded and optimized for the quickest path from field to mill.
Oh, wow.
And they have been systematically upgrading their harvesting equipment to newer models that require significantly less maintenance downtime. They essentially tightened every single bolt on the operational floor to ensure that the lower volume didn't bleed out their margins.
And that extreme cost discipline sets up a very powerful scenario for 2026. Management's guidance calls for low double-digit growth in crushing volumes for the year.
Yep.
When you combine low double-digit volume growth with those flat 12.8-cent cash costs and an ethanol realization sitting way up at 16.5 cents, the margin expansion isn't just a hope, it becomes highly predictable math.
Absolutely.
And to further mitigate the risk on the sugar side of the switchboard, they have already hedged 49% of their 2026 sugar output at a highly profitable 15.7 cents per pound.
They are structurally locking in the margin floor everywhere they possibly can. They locked the natural gas input costs for the fertilizer division through 2027, and they hedged half of their entire sugar output for the year. It is a masterclass in removing downside volatility.
Let's move to the third pillar of this newly rewired corporate structure, which is the food and agriculture segment. As part of this transformation, they took their legacy crops, rice, and dairy segments and consolidated them into one unified reporting segment.
Right.
And let's be totally honest, 2025 was a brutal year for this group. They faced lower soft commodity prices across the board, highly uneven crop yields due to localized droughts and floods, and severe inflation driving up their dollar-denominated costs. The margins were absolutely squeezed.
It was undeniably a challenging operating environment. But the turnaround plan they have implemented is highly aggressive, fundamentally sound, and already in motion.
What are they doing?
First, they executed a major cost-cutting and capital efficiency initiative by slashing their total planted area by 22%.
Wait, slashing your revenue-generating footprint by a fifth? That seems counterintuitive for a growth company.
It is classic addition by subtraction. They didn't just randomly abandon land. They executed a deep forensic audit of their yields and actively renegotiated or simply dropped their lowest margin, worst performing land leases.
So trimming the fat.
Exactly. If a piece of leased land wasn't clearing a strict hurdle rate for return on invested capital, they cut it loose. They are intentionally shrinking their gross footprint to grow their net margin, focusing their capital and fertilizer solely on high-yield, high-conviction acreage.
That makes a lot of sense. What else?
Second, they are shifting their crop acreage heavily toward rice. Within the current macroeconomic cycle, rice has demonstrated far more resilient, inelastic pricing dynamics than soybeans or corn. People will substitute out of certain proteins, but rice remains a baseline staple.
Right.
And third, they are flexing their dairy production with the same switchboard mentality they use in ethanol.
How does that work for milk?
Because their dairy operations are fully vertically integrated from the cow to the processing facility, they can choose on a weekly, sometimes daily basis, whether to sell fluid, pasteurized milk into the domestic Argentine market or process it into dehydrated powdered dairy for the export market.
Oh, that's clever.
Yet that decision is driven entirely by whichever market offers the highest margin at that exact moment.
And we cannot talk about this segment without talking about the country it operates in, because Argentina is currently undergoing a massive systemic economic rewiring of its own.
Right. If we connect this micro-level execution to the bigger macroeconomic picture, the ultimate catalyst here is the new Argentine administration.
Yeah, Milei.
Yes. We are witnessing broad, sweeping economic reforms designed to tear down decades of protectionist policies. For agricultural operators, the most critical shift is the systematic lowering of export taxes, what they call retenciones, locally.
And those were brutal, right?
Historically, Argentina heavily taxed agricultural exports to fund the government, which brutally crushed local farm margins. A domestic farmer had to compete on global prices while paying a massive penalty just to get their product on a boat.
Ouch.
The new administration is lowering those taxes and aggressively deregulating agricultural trade.
Which means the exact same ton of rice or powdered milk produced at the exact same cost is suddenly wildly more profitable simply because the government is taking a smaller cut at the port. A drop in export taxes falls straight to the free cash flow line.
Exactly.
All right, we have talked about a lot of sunshine and bull thesis mechanics here. We have fixed cost urea printing money due to global geopolitics. We have ethanol margins expanding on the back of Brazilian E30 mandates, and we have Argentina deregulating.
All very positive.
But let's play devil's advocate. I want to look at the debt. Because to buy this beautiful fertilizer cash engine, they levered the balance sheet right up to the edge.
They definitely did.
pro forma net debt has swelled to $1.5 billion. That pushes their net leverage ratio up to 3.3 times EBITDA. Now, 3.3x isn't exactly distressed territory for an industrial firm, but it's a hell of a lot higher than the pristine 1.2x they were sitting at previously.
It's a noticeable jump.
And the credit markets definitely noticed the added weight. Moody's did not like this move at all, officially downgrading Adecoagro's corporate family rating from Bay2 down to B2. In their thesis, they specifically cited the higher leverage and the inherently increased exposure to Argentine's sovereign country risk.
You cannot ignore the credit rating downgrade. It is a very real headwind, particularly for their future cost of capital if they need to refinance any short-term paper. A B2 rating prices their debt firmly in high-yield territory.
Right, so how are they handling that?
Well, management is hyper-aware of this, and they have presented a very clear, mathematically sound deleveraging path. It all comes down to their capital allocation strategy over the next 24 months. The board of directors proactively stepped in and strictly capped the 2026 cash dividend at just $35 million. They are intentionally shutting off the excess shareholder distribution valve.
No huge payouts for a while.
Instead of returning capital to equity holders or buying back shares, they are prioritizing using the massive, unhedged incoming cash flow from the Profertil urea business to aggressively drag that $1.5 billion in debt down.
What's the target?
Their publicly stated goal is to get that 3.3x leverage ratio back down toward their historic, conservative comfort zone of 2.0x as quickly as humanly possible.
And the equity analysts on the sell side seem to be entirely buying this deleveraging narrative. If you look at the desk notes that dropped immediately after the print, the sentiment is overwhelmingly bullish on the math.
Oh, absolutely.
Bank of America upgraded stock to neutral. They slapped a $9.0 price target on it, and they jacked up their 2026 EBITDA estimates for the consolidated company to an eye-watering $617 million.
Massive revision.
Morgan Stanley also stepped in, upgrading the stock to equal weight, and their thesis specifically praised the significant operating leverage that the Profertil asset brings to the table.
Right.
The street is basically looking at the balance sheet and saying, yes, the debt is high, the Moody's downgrade hurts, but the cash engine they just bolted onto this company is powerful enough to outrun the interest expense.
Which perfectly sets up the ultimate tension for investors right now. It is a race against the cycle.
A race against the cycle. I like that.
Do you believe the Profertil cash engine will perform as advertised, capturing that massive import parity margin, and pay down the principal before the broader agricultural commodity cycle turns, or the debt becomes a structural suffocating burden?
Which brings us to my absolute favorite part of the show. We have officially entered the "This is not financial advice" segment.
Here we go.
This is where we strip away the pleasantries, look strictly at the structural mechanics of everything we just discussed, and pitch an outrageous yet plausible trade idea. Imagine you are a hedge fund pod analyst pitching to a grueling, unforgiving investment committee that is looking for any hole in your logic. What is the structural trade to exploit this exact macroeconomic setup?
All right, committee. Here is the pitch. I call this trade the delta-neutral fertilizer deleveraging spread.
I love the name already. It sounds expensive. Give me the specific legs of the trade.
The long leg is conceptually simple. We go heavily long agro equity at current market prices.
Okay.
The short leg requires some institutional futures access. We dynamically short front-month international urea futures contracts.
Wait, I need you to unpack the rationale here.
Correct.
Why are we pitting the equity of the company against the very commodity it relies on to produce its cash? Usually, if you are long an oil company, you are long oil. Why the pair trade?
Because we are exploiting the specific leverage dynamics of the balance sheet. Let's run the bullish scenario first.
Okay, walk me through it.
If geopolitical tensions in the Middle East persist, or God forbid escalate, and keep global urea prices at these historic highs, Agro's unhedged 1.1 million tons of capacity are going to print an absolutely obscene amount of free cash flow.
Right.
Management will take that tidal wave of cash and rapidly pay down their $1.5 billion debt load. Now, here is the secret to highly levered equities. Debt paydown causes massive nonlinear equity multiple expansion.
Yes.
The overall enterprise value of the company might stay exactly the same. But as the debt slice of the capital stack shrinks, the equity slice of the pie grows exponentially to fill the void.
So the stock price skyrockets.
Exactly. This aggressive multiple expansion on the equity side will mathematically outpace the mark-to-market losses you're aiding on your short urea futures position. You win on the spread.
That is a brilliant way to capture the balance sheet transformation. But let's stress test this, because committees don't just buy the upside. What is the hedge? What if peace breaks out tomorrow in the Middle East, the shipping lanes clear up, and the global supply chain normalizes instantly?
That is exactly what the short leg is for. If the conflict resolves and supply floods the market, urea prices will crash. Your short futures position instantly prints massive gains. It catches the entirety of that downward move.
Okay, but doesn't the equity tank?
You might intuitively think your long AGRO equity position would get absolutely crushed as their primary revenue driver plummets. But the downside is structurally cushioned.
Because of the gas.
Exactly, because of the Vaca Muerta natural gas contracts. Their input costs are fixed at that $180 per ton equivalent through 2027. They remain cash flow positive and highly profitable even at the absolute bottom of the historical fertilizer commodity cycle.
Right, they can't lose money on it.
The equity won't fall nearly as fast as the commodity itself because the market knows they aren't bleeding cash. The futures win outruns the protected equity downside.
Let me push back on one critical vulnerability in that trade, though. What happens to the short leg if a stray missile hits a tanker in the Red Sea tomorrow and urea spikes 20% overnight?
That's the tail risk.
Your broker issues a massive margin call on those short futures. You are bleeding cash on the derivative desk while waiting for the equity to slowly re-rate on the next quarterly earnings report. How do you survive the duration mismatch?
You manage the duration mismatch through dynamic position sizing and utilizing out-of-the-money call options on urea as a catastrophic tail risk hedge for your short position.
Capping the loss.
Right. You cap your margin liability on the future side, so a 20% overnight spike doesn't liquidate the pod, giving the equity the weeks or months it needs to mathematically absorb the higher cash flow expectations and expand its multiple.
That is a phenomenal, deeply considered structural arbitrage. You are perfectly isolating the fixed cost advantage of the preferred asset, that impenetrable locked-in gas contract, while entirely neutralizing the global commodity cycle risk.
Exactly.
If urea moons, the balance sheet equity leverage outruns the futures loss. If urea tanks, the futures win outruns the structurally protected equity downside. It is a beautiful, pure synthesis of the mechanics we've been discussing for the last hour.
It capitalizes on the exact transformational nature of the company that the market is just beginning to understand and price into the stock.
What an incredible breakdown. Let's recap the core thesis for everyone mapping this out. Adecoagro is no longer just a farming company subject to the whims of the rain.
Far from it.
The market didn't bid this up 14% on massive volume because of next year's sugar yields or a slightly better rice harvest. They bid it up because Agro has successfully transformed into a levered, cash-flowing fertilizer and ethanol industrial platform.
Yep.
They have locked-in costs on the bottom line, floating, geopolitically driven revenue streams on the top line, and a strict corporate mandate to pay down their debt.
If you are tracking this thesis over the next 2 quarters, there are 3 specific, highly measurable KPIs you need to monitor.
What are they?
First, track global urea prices and the geopolitical news flow specifically around the Strait of Hormuz and the Red Sea. That is your revenue ceiling. Second, watch the Q1 ethanol margins coming out of Brazil to ensure that their continuous harvest model is effectively capturing the mandated E30 premium.
Okay, and third?
And third, and perhaps most importantly, scrutinize their next earnings release, specifically for the velocity of that debt paydown. If the leverage ratio isn't dropping, the multiple won't expand.
That is the scoreboard. And as a strict reminder to you listening, all trade ideas discussed on this deep dive are strictly for informational and educational purposes. This is not financial advice.
Absolutely not.
Deploying naked short futures against levered equities is a great way to blow up your personal portfolio if you don't know exactly what you are doing. Thank you so much for tuning in. We'd love to hear your own takes on the Profertil acquisition, so reach out and let us know if you think they bought the absolute top of the global fertilizer market or the bottom of their own industrial growth cycle.
It will be a masterclass in capital allocation to watch them execute this over the next year.
It really will. We started today talking about an ugly trailing quarter being like a car up on cinder blocks. But before we sign off, I want to leave you with one final, broader thought to mull it over.
I like these.
If Adecoagro successfully proves that you can take a highly volatile, weather-dependent agricultural company, lever it up, and stabilize it by bolting on heavy chemical and energy infrastructure, does this signal the permanent death of the pure-play agricultural stock?
Whoa.
Right. If every major farming conglomerate realizes they need to become a quasi-chemical and energy hedge fund just to survive the climate and commodity cycles, what does that actually mean for the fragility of global food security? If the margins are always better in ethanol and urea, who is going to be left just growing the food? Until next time, keep digging into the data.